out of Switzerland, I think the shortest way here, is Benjamin Mueller. He's the advisor to the Swiss National Bank. We have David Newns, the head of Sixth Digital Exchange. We have Fernando Vazquez, the CEO of SBI Digital Assets. And last but not least, Teana Baker-Taylor, who is advising governments on both sides of the ponds, both the US side and the UK side and the European side. The panel is moderated by none other than Giancarlo again. So thank you very much. Welcome you back on stage.
Well, it's great to have the opportunity to come back on stage and come back with so many great colleagues and thinkers on the subject of both sovereign and non-sovereign forms of value. And I want to begin the conversation actually by turning to what's happened in the last 48 hours, the approval of spot Bitcoin ETFs. I think that decision, we've talked here in the halls and on panels about the significance, but I want to raise a different question and throw it out for the entire panel. Does it tell us something about the United States' its role as the provider of the world's major reserve currency coming to grips with a future where a central bank reserve currency like the dollar can coexist with crypto? Is this more than about a few ETF approvals? Is this really about a government after 10 years consideration saying, well, maybe there's a future where digital currency, a digital system of value, and a traditional dollar can coexist?
Well, I think it's important to clarify that first and foremost, this is a validation of Bitcoin as an asset class and a validation of the tech, not necessarily a validation of Bitcoin as a means of payment. I think that would be the main takeaway and differentiation to make.
Absolutely. I like Matthias Imbach's metaphor of it's like a free trade agreement between the traditional financial marketplace of the financial sector and so TradFi and this new economy that is Bitcoin that will actually allow sort of foreign direct investment, as it were, from TradFi into Bitcoin. But again, looking at it primarily at this point in time as an asset class, as an investment vehicle.
Yeah. In the United States, we have a phrase of Nixon going to China. It was a recognition that the world would, communism and free markets would exist side by side in the 1970s that changed things in a way that hadn't existed before.
So an absolute recognition that it's not going away.
Not going away. Teana.
I would absolutely agree that it's an acknowledgement that it's Bitcoin specifically and products that use it as an underlying are in demand, first and foremost. I would also argue that we have seen other governments make that acknowledgement already. So, we talked a little bit about MiCA yesterday, and within MiCA there are several avenues by which crypto assets, stablecoins specifically, once licensed, will be able to be integrated within the traditional financial ecosystem in the form of payments, for example. So while maybe not as hotly anticipated or maybe not as sexy as an ETF, we have seen governments already acknowledging that these assets are here to stay and play a role in our financial evolution.
Yeah, I also think that for Bitcoin as an asset class or cryptocurrencies or crypto assets in general, I think this is significant. However, given that we are talking today about CBDC and stablecoins, I wouldn't go that far as you did, Chris, that it is an acknowledgement of this asset class to be used as money.
So let me come back with another question. To what extent, in my remarks, I talked about the over 100 countries experimenting with CBDC. To what extent are governments looking at CBDC really forward-thinking on their part, recognizing the value proposition of distributed ledgers of value, or in addition to which, is it a defensive mechanism because of the concern that digital systems value outside of government control will proliferate and indeed accelerate?
Yeah, I think this might be true that there is this dimension to it, but in general, I would say that around the world, around the globe, central banks have acknowledged the potential of this technology and start to work on it and make themselves ready for that potential future. And I think there are a lot of exciting experiments around the world, a lot of exciting pilots that we can talk about today. I think one of the, in my view, most exciting pilots is going on in Switzerland, actually.
Yeah, talk about it.
Okay, so here in Switzerland, as of the 1st of December, we have launched a pilot that tests the use of wholesale CBDC issued on SDX that David Newns heads up here. So that on this wholesale settlement infrastructure, central bank money in tokenized form can be used to efficiently and safely settle tokenized assets. And I think that's remarkable because we're one of the first, if not the first, central bank that issues its central bank money on a third-party infrastructure that is running on distributed ledger technology.
But I think that's a testament to Switzerland. So it's, I don't think, news to anybody in this room that Switzerland has always been at the forefront of looking at how to integrate this technology into the way we work and live. I have a slightly different take. I mean, the SNBS side, I think that the initial attraction or focus on CBDCs was a really direct reaction to Libra. Libra scared the shit out of governments. And the idea that there could be this global currency that would potentially create its own monetary policy and disrupt governments setting that monetary policy was terrifying. And I think we went from, a very rapid reaction, and certainly China was the first to come out and seize that opportunity, to a little bit more thoughtful contemplation around what this would actually mean. And so I think that the design choices that we're looking at now, the focus on privacy and programmability, both the advantages and enormous risks around those, are now being contemplated in a far more intentional way than maybe 2 years ago when this, rush to develop CBDC started.
Yeah,
It's pretty remarkable when one technology can send shivers around leaders in Beijing, Brussels, and Washington all at the same time.
Yeah.
Fernando?
Yeah, in the context of per country issues, CDBCs, stablecoins, and the Internet of Value that you alluded to, I think it's important to look at what happened with the Internet of Information. Yeah. People don't realize that even though the protocol itself in the Internet of Information is fully distributed, we still have ISPs, Internet Service Providers, both global and regional. And those ISPs are able to issue so-called ASNs, Autonomous System Numbers. So I would argue that the gain here is that we have a single Internet of Value, but with the equivalent of autonomous systems, what you already have in the Internet of Information. So in that sense, I'm cautiously optimistic. I think there's going to be some convergence in terms of tech, but sovereignty is important. That is here to stay. So I think we have the equivalent of ISPs, autonomous systems. We might call them banks. It can be a new set of gatekeepers like the telcos. But I kind of disagree that we will end up with many different silos, different networks. I think it's going to be a single one, same protocols, but again, with ISPs, autonomous systems that will allow nation states to keep sovereignty over their currency.
Yep. David, we were speaking before we came on stage about the role for wholesale experimentation and systems. In my remarks, I talked about, in fact, if we look forward, there's actually more retail pilots for CBDCs on the slate than there are wholesale. But your view is the wholesale is really the important experimentation. Do I have that right?
Well,
why is that so?
I think it's the one with the greater clarity of use case. So, I mean, to Teana's point about the sort of the genesis of the activity in the first place around investigating CBDCs was a reaction to a threat which has now gone away. So the initial use case was, do something that'll be the alternative to Libra. Yeah. And then Libra goes away, and now it's like, okay, so now why are we doing these things? I think that changing the juggernaut in terms of its direction when it comes to these sort of entities is going to be a bit difficult, given the nature of those entities. And there's a very, very clear differentiation in my mind between the retail CBDC sort of potential use cases and the wholesale CBDC, where we need tokenized central bank money in capital markets to settle transactions that are being conducted in regulated services, as well as provide wholesale cross-border payments with a riskless settlement asset. And in that context, there's really nothing else that can do. And we can talk as much as we want about stablecoins and the sort of the functionality that comes around with those, or even crypto as a potential sort of means of payment in that context. It needs to be riskless. Otherwise, it has a balance sheet charge associated with holding it as a market participant. And that means that you just don't scale that system. So if it's commercial bank money, it's not good enough. So if it's tokenized commercial bank money, so tokenized deposits, it's not good enough. If it's a stable coin, it's still commercial bank money, it's not good enough, because to actually carry out activities means it's just not capitally efficient. And that's something we've very much seen in terms of the evolution of SDX has been, we've had our own, essentially, as good as it gets, which was a tokenized deposit held one-to-one reserve at the Swiss National Bank as tokenized Swiss francs as an on-chain settlement asset. But again, doesn't scale because it's commercial bank money.
Now I'm looking at Benjamin. I'm not sure he's buying what you're selling here, David. So
no, I kind of agree, but I would like to pick up on several points that were made, if that's okay. So first of all, totally agree that Libra was a wake-up call, and I think for good, to be honest. When it comes, for instance, to cross-border payments, it has triggered a huge initiative under the umbrella of the G20 to improve cross-border payments, and I think there is some real merit in this initiative. And second of all, I think to Fernando's point, this technological innovation kind of offers us the possibility to rethink our monetary system, and I think that's super exciting. Yeah. And I very much like what you said, Chris, in your keynote, that we should come from the requirement, from the principles to think about this. And on David's points, I actually agree. So traditionally, central bank money serves as electronic central bank money, I should say. I'm not talking about banknotes. I'm talking about electronic central bank money. Serves as a settlement asset because those transactions are simply too big to use private money to settle those. If the private money issuer goes bust, you have a huge issue. So I think it kind of makes sense to map today's financial system into the future with, for instance, the use of wholesale CBDC makes a lot of sense.
And also, I would argue the viability of retail CBDC. Commercial banks, I mean, most of the money is issued by commercial banks, right? And you're really good at getting money to the hands of all of us, right? And M2 money is super mature. They have all the tooling, all the operational capabilities, right, to do that. And I don't think the central banks are ready to do so. To model what's going on and to innovate on the payments.
And they're not designed to. I mean, they're not designed to provide cash directly to service us. And I think that is, Chris, you identified that there are all of these retail projects or evaluations going on. But as David rightly says, we have a really critical need at the wholesale level that, I could throw up a whole bunch of examples in addition to the one that David just gave. When you think about from a retail's perspective, how does retail use money? It's very, very different than capital market settlement. And so the optionality of different types of payment options, I think, is where things like stablecoins and private money, we have a two-tier banking system. I really dislike the CBDC versus stablecoin discussion. It's not a fight. It's not a war. It's not a zero-sum game. There will be both, and I think they will serve different use cases. One of the key things I think that from a central bank perspective and the idea of a retail CBDC, a lot of these retail CBDCs, most notably Europe, the digital euro, and the digital pound, and some of the concept designs, they are meant to be nationally used only, right? Yeah. So they won't even solve that cross-border problem. Yeah. They won't be interoperable in the same way that we do, FX today. Yeah. And so then it kind of begs the question, why are we doing these things? And if they're not going to be interoperable and they're not going to solve some of those challenges that exist, then what's the point? And I think we just need to be very, very mindful, not just about reinventing the system that we have today or digitizing the system that we have today, but future-proofing the evolution of our financial infrastructure to be ready to service those new business models that we don't even know about yet.
Yeah. I'd like to contradict myself.
David, yeah.
So in terms of clarity of use case, so I was speaking to the gentleman over here from the Lebanon at the fantastic speakers dinner on Tuesday evening. I think we've got to be careful about not looking at the US and Europe when it comes to applicability of use case for CBDC, because if you look at where they've already been deployed, especially in sort of in developing markets, they're often very, very tangible, very sensible use cases. So the Lebanon being an example where the banking system is essentially not in the best state at the moment, and therefore moving on to a completely new technology and upgrading the whole thing in basically a bit of a white space makes a lot of sense. And the Bahamian sand dollar also had a particular use case because lots of islands and moving around cash physically is very expensive. So there's obviously a very tangible use case there. And then you do hear about sort of remittance use cases as well for, again, developing countries. I struggle a little with the developed economies around use case, but I see that there's probably, again, a kind of kaleidoscope of opportunities in the developing world and outside of our sort of myopic focus around the developed world.
But some of those jurisdictions, David, that you mentioned too, getting dollars is very expensive, right? Yep. Even if you are an economy that's pegged to the dollar. So if you're a central bank that operates your currency on a peg, you still have to have dollars, and getting those dollars is expensive. And so this potentially solves some of those problems, or potentially a privately issued stablecoin that is underpinned by a CBDC could then be that balancing asset for those pegged currencies.
I do not want to slow down the discussion, but I think very important points that were made before. So first of all, I think it's true that central bank money, let's take banknotes, are not super innovative, but I think that's good. I like banknotes, although I don't very much use them. I have it as a backup, and I think it's good as it is, although it's not very efficient. And it incentivizes the private money providers, right? Because you always have this risk that people will turn to banknotes. So I think that's important. And then the second point where I partly disagree with Teana is the fact that I see on a regional level that central banks are indeed willing to cooperate. Yep. And my hope is that we get from that regional level more broadly to almost a global level, or at least within the Western Hemisphere when it comes to cross-border.
Yeah, I would be delighted to be wrong.
Yeah.
I hope you're right.
I would love to see some regulatory alignment, and you might disagree with that, because I think the end game is like the Internet of Information. I think ideally, the Western world will be single internet. Of course, there will be autonomous system, ISPs here and there, but my ask to you guys, right, and I don't know what happens with the BOJ or GFSA here, but is to make that happen. I think it's a proven model, and we can make it work.
I think the criticality is clarity of use case on the one hand, but a nomenclature that's under, so taxonomy and standards are going to be absolutely essential. So the really, really boring stuff.
Yep.
Let's actually drill down to that. Teana, you're a passionate advocate for interoperability. You see it as an opportunity to really reduce financial risk in the system. But are we really moving in that direction? Or are we moving more in a direction of a lack of interoperability? I share my own personal fear that we're going to have systems that are designed for specific use cases without really common denominators on them. And we may, just as a society, we're deglobalizing globally. Are we also going to see a future where we're going to have just an array of systems, some of which interoperate, many of which do not? And what are the risks to the global financial system in that kind of a situation?
Yeah, indeed. I think when we think about the way that we used to, travel, if you were going to multiple countries and you would get home and you would have your actual physical wallet and it would be, the leftover bills and coins that you had from all these different places. And it was just too much of a hassle to do anything with. And maybe you threw it in a jar, maybe you threw it away, maybe you went to your bank to convert it, right? But you were having to use all of these different types of assets when you were moving around. And so if I think that in a digital way, like if you go into maybe your Apple wallet, you've got all of these different cards or a bank card, or it might be a digital wallet. And I think that there are some financial institutions that are trying to think through that around having, one kind of omnibus ecosystem. And we've gone through these different kind of channel strategies. We went through this with the fintech, explosion of kind of electronic money, and how you could be using your bank account and your card and maybe, your Bitcoin wallet in this kind of interchangeable, interoperable way. And I think that there's a lack of regulatory clarity that provides for all of those counterparties to be able to work together today to develop that. And it's really hard for financial institutions to risk assess that. Yes. And so when you were thinking about standards, I think that's where standards, principle-based standards that are high level enough that regardless of your rule of law or your regulatory regime, that we can kind of agree on these 10 principles. If we don't, then what we're going to have is this incredible fragmentation going back to before globalization that we experienced. And that is going to be replicated in our financial system. And I think that is exacerbated by, I think what we can all kind of see around the world is this kind of siloing or a return to a very kind of nationalistic mentality. And even in the crypto regulatory community, I mean, countries are seeing this either as an opportunity to differentiate themselves or to be competitive. And so if there is an opportunity to kind of be a little lighter, a little looser, or more strict, then that creates a competitive advantage, right? And so that does not serve interoperability.
I think there's a lot of pressure also from the ecosystem, because if you don't do anything that is not alignment, you will see the stable coins keep growing. That's actually been the case. So you end up with unregulated or badly regulated stable coins. And I think that's not what we want in terms of financial stability, right?
But see, that's a great point. So today, Tether moves around the world, right? Yep. It is a kind of global, free-flowing asset. It is the internet of money, for example. And there's an awful lot of it, deep liquidity. Now, as governments around the world put in place new regulations specifically for stablecoins, and there's a lot of them. So there's MiCA. The UK is coming out with something next year. Hong Kong just issued a consultation. Japan regulates stablecoins. And within each of those regimes, the global US dollar that's moving around now has to adhere to rules that are very specific for that country. And you're starting to see concerns about fragmentation, because now USDC could be USDC France, USDC Japan, USDC US, and that's not one USDC. So
but you see USDC going down and USDT going up, right?
Yes.
And other stable coins. Is that what we want?
So let's talk about stablecoin standard setting, global regulations, Fernando, you talked about. I put out an op-ed about 6 months ago criticizing the stablecoin legislation in the United States for having not one word in it about privacy, economic privacy. I'm not fully familiar with Japan, but I do know that the European proposals say very little about privacy. Where is global standard setting in this digital future of money on the values that I talked about earlier? And what do we need to do to get some of those values advanced into core principles of development for both retail and wholesale digital money?
Yeah, I have to be careful with my regulator sitting just in front of me, Ushida-san. So, so I would like to mention that in Japan, let me put a word for him. There's a lot of emphasis in AML and making sure that all the wallets they use to transact are fully KYC'd. But that does not address the privacy issue. Because if you apply blockchain, all the transactions are public by definition. But there are privacy enhancing technologies that you actually alluded to. So I think we as an industry have been a bit lazy when it comes to defining the privacy requirements. The tech is already there. It's more about what's the business model. What are the semantics for the coin? If you want programmability on-chain, depending on the use case, sometimes you might need full privacy, but if it's like a BlackRock ETF, you actually need to disclose everything. So you don't need the privacy. Actually, so it's the other way around. So I think it's up to us to define the business cases and come up with the requirements. The tech is there.
But it feels like this privacy issue, although there's a lot of advocacy going around privacy, it feels like the general population is not really waking up to just how insidious this general trend towards the complete absence of privacy. And again, the hypothesis behind Web3 is that it inverts that model and puts privacy at the forefront of that in terms of how that technology can deliver. But I am kind of concerned that this isn't what people are thinking about. They're thinking about just pure utility. It's like, I can use Tether because it's just the least pain. It's the easiest to use. It has the deepest liquidity, so I'll go for that. Without any context about what does it actually mean? Am I really buying it? What am I buying into when I'm actually purchasing that and leveraging that particular technology?
Can I challenge that? So in our case, we as BI, we have exchanges. We also are significant shareholders of some of the biggest hardware wallets, right? And we look at the client base in developing countries, right? You see that most of the people leave the stablecoin sitting there. They want to use it as a store of value, like a proxy to a money market fund, basically. But then you go to Japan and other places, it's more transactional. So I would argue in certain cases, when those want to use this as a store of value, privacy is important, but not that much. Because it's there isn't that much you can learn from, what's going on. Because literally, the thing is just sitting there. But in more advanced countries where it's more transactional, I think the privacy requirements should be pretty high. Especially when it comes to doing shopping, stuff like that. I would argue that it should be fully private and only accessible to those who need to know about what actually happened. And that can be addressed off-chain. You can have audit trails, and the tech is there. Again, I think it's up to us to define what the requirements are and then engage with the regulators. I wouldn't blame just the regulators.
Christopher and Sheila talked about this yesterday, the idea that we've been trained by big tech to almost give away our privacy for free.
Yeah.
And I do think that our digitally native generations that are a couple, a generation behind us anyway, are used to giving up their data in exchange for these free services. And they know they're their product, and I think they don't care. And then, in the crypto community, with this we're going to be our own bank. We're not going to rely on these third parties. But I think the reality is the average person doesn't really want to do that. That's hard, and it requires some effort. But there will always be those people. I think that one of the things that came out of the UK's consultation on a digital pound was there were a lot of privacy concerns, but there were also a lot of programmability concerns. Mm-hmm. And so in the age of these huge LLMs, being able to process data in an incredible way, coupling your money with your spending patterns. I mean, because Visa and MasterCard already know an awful lot about us anyway, right? Couple that with the tracking devices that are on our phones, and the next thing you know, if this money is programmable in a way that the government says, well, you drank an awful lot, you bought an awful lot of alcohol this month.
Yep.
Or, you bought an awful lot of sugar and, now you're using all of this government money in the form of NHS visits because you have diabetes. Like, it is a very kind of 1984 dystopian view. But I think once people actually realize what's potentially possible, then they start to wake up. But I always feel like people wake up a little too late.
Yeah, I think it's far more articulated of my perspective as well, is that absolutely people are just allowing this to happen. And absolutely a generation that's comfortable with giving away their privacy. That's just how they roll.
But I agree with you. I think that the industry also we do a great job of saying, oh, we can solve these problems. We can solve these FATF concerns and AML concerns with, ZK proofs. But we don't build that in, right? So we're telling regulators that this is possible, and they're like, that sounds amazing. Can you show me an example? And then we're like, oh, we don't actually have anything that does that today.
I want to ask a question for the group. It's a poorly kept secret that the AML KYC regime is actually a very bad regime at catching money laundering.
1%.
Yeah, 1%, the amount of false positives through the moon, the cost of running it. But to what extent is it a Trojan horse into the Internet of Value to really give government control over information flows? To what extent is it a barrier to entry for TradFi to hold on to what they've got as long as they can? To what extent are we limited in how much we can develop this Internet of Value by the clinging on to this AML KYC system?
I think it is the intention of a group of a particular group of actors, I suppose, within the TradFi system. I don't think that that banks would be particularly perturbed if there was a better way to do AML. I mean, they also know exactly that they spend vast amounts of money achieving very little except for checking boxes. And it's absolutely critical they do because they have the legal obligation to do so.
Well, it keeps their DeFi competitors out of the system.
But it's always the case. I don't think it's a defensive moat for them. That AML KYC is a defensive moat. I think that capital markets always want to do things more efficiently, and that so and one area that everyone always complains about is how much money we spend on compliance and AML KYC and how long it takes to onboard customers. And wouldn't it be great if we could have an outsourced, decentralized version of that, but that is something the regulator has to be happy with, and so on and so forth. It just takes a long time for this technology to make itself sort of known and understood and trusted by regulators and by governments to actually get adoption. But I would absolutely love that, and I think that actually the capital markets would
See,
too.
I think I disagree with you, David. It exists today, but I'm telling you, I truly believe this. We could build it, and we don't, because it's not sexy and it's not going to make a lot of money. So instead, we've pumped tokens and we've created DeFi lending and we've done all this other cool stuff. But if we really wanted to solve privacy issues, somebody would, and I'm not a technologist, but if somebody wants to build it up, I'm happy to help you. If we could tokenize identity in a way that was passportable and was permissionable, so I only give you my healthcare information and I only give you my financial information, and I could take that with me and I could prove that it works, that would solve a lot of these problems and would actually address money laundering and terrorist financing, because I don't think anybody wants
to fund that.
I think
market participants want that, though. And I think that they would be willing.
Then why is nobody building it?
Because I don't think that's it, as you say. It's not sexy.
It's hard.
It's hard. It's not sexy. It requires coalitions of.
Nobody's going to get rich doing it.
There is a trade-off between convenience, obviously, and privacy. I mean, that's apparent. But there is work, and I want to point out to the audience the work on Project Tourbillon, based on the idea by Thomas Moser and David Chaum, to come up with a retail CBDC that actually brings you AML KYC compliance, but on the other hand protects the privacy to utmost levels, which is nice. And I think at least we have the acknowledgement that this is important, that there is progress in this area.
Where can we find out more about that, Benjamin?
So this is on the BIS website. This is a published report.
I'll come to you in a second.
And Thomas Moser will come, I think, tonight. So you should definitely approach him directly.
Oh, good. We'll look forward to hearing from Thomas. Fernando.
I would agree completely. I mean, most of the tech to make this happen is there. The NIST, they define different identity assurance levels. Right? If it's, you have the nation state issuing the credential, then you get the highest identity assurance level. If it's a bank, it might be level 2, right? If it's a non-regulated entity, it might be level 3. And we actually have the same kind of scheme for authentication authorization. All of that is already there. There are the standards. Again, coming from the NIST, many countries like Japan and others are following that. We even have the OpenID Foundation working on verifier credentials. So some of us have already integrated that with blockchains. But what's missing is doing the non-sexy, boring job of defining what are the requirements for each of the different use cases.
And when we're forced to, we do. So I think, FATF recommendation 16 basically applied the Banking Secrecy Act, the travel rule, which is not necessarily easy, but it's straightforward to facilitate in the traditional banking system. You collect all this information, you attach it to the transaction, and there's all these intermediaries to make sure that that happens. So, FATF said, oh, you need to, do the same thing in crypto, and we were like, there's nowhere to attach all this information in a transaction. And FATF said, well, figure it out. You've got like a year. And so the industry kind of came together. It was an existential threat. And it almost like takes these existential threats for us to come together and solve these problems. And it's clunky. And there are service providers that can keep these or enable these firms to be compliant. But we're replicating an existing system, to your point, that catches 1% of money laundering. So why? What is the point? Let's not make new stuff to replace the old stuff that didn't work in the first place. Let's just make cool stuff that's new that works.
Benjamin, can we make cool stuff that works?
I hope so, yeah, I hope so. But I agree. Regulation, different legal underpinnings is a challenge. I agree.
If you don't mind.
Yeah, please.
People keep saying that crypto DLT is disruptive. I disagree completely. It's part of the digitization of finance. It started in the 60s with mainframes. Then we had the internet come in, and all of a sudden, you had banks who used to be just banks running an IT department and issuing credentials, right? That's not what they do for a living. Right? Then you have DeFi, DLT come over, and look, you can leave all the IT, all the infrastructure to some kind of magic universal computer. But you can have a contract with, Bitcoin Network or Ethereum. You can with Amazon, but not with the DLT. And when it comes to identity, there's all this talk about the ID, you name it. The last few years, it's been banks and financial institutions issuing those credentials, but who are going to be the credential issuers going forward? Who are going to be the gatekeepers? Who are going to be the ISPs of the internet value? Maybe it doesn't need to be banks. Some kind of legal entity has not been defined yet. But again, I don't think it's up to the regulators. It's up to us if we believe in, in the potential of this technology to define it. Again, we have been lazy, myself included.
I got a question for the group. I'd like everybody to take a shot at it. The year is 2030. 5 currencies: the dollar, the yuan, the euro, the pound, the Swiss franc. In 2030, for each of those currencies, will it be digital, will it be sovereign, or non-sovereign, or both? Benjamin, you're giving this a lot of thought. What do you think?
That's a good question, and you put me on the spot here. I would say
that was the point.
we will see quite a number of digital currencies going forward. We will see, as you pointed out in your speech, retail implementations, but also wholesale implementations. But I fully agree with what you said. I think you will see non-sovereign and sovereign money. So we will have this mixture of private and public money. But I want to say that we already have that today, and that's okay. I agree with the point that interoperability is an issue here. Fragmentation should be avoided. $1 should always be a dollar, and the Swiss franc should always be a Swiss franc. And I think this is what we need to be careful about.
Teana, you want to take a shot at that?
So 2030, kind of knowing what I know, I think there'll be a mixture. So Switzerland, yes, I think there'll be probably a CBDC and well-operating privately issued stablecoins. I think there will probably be a digital euro. Maybe the timing's a little bit off because that keeps getting pushed back. And there already are stablecoins that will be licensed soon. I don't know what the adoption of those are going to be. The UK, I think, will have a CBDC potentially, but I don't know that they're going to have a stablecoin. And the way that those stablecoin regulations are looking, I don't know who would want to build one. It's really tough. So I don't think there will be a great stablecoin in China, but I think you're going to get stuck with the CBDC only. And the dollar, no. I'm going to leave that to you. That's your problem to solve, Chris.
So I think that there is already a wholesale CBDC Swiss franc today. So on SDX, thanks to the SMBs, have actually a 3 project. So I have to believe that will continue through to 2030. Otherwise, I have different problems. So that I will simply hope for the continued support from our valued partners, the SMB. I completely I agree with we're going to have a Cambrian explosion of different forms of money. I think that across all these different currencies, there will be some sovereign and some that are not, and that will be regulatory dependent. I think what is going to be interesting is that in that time period, because the adoption will obviously be quite substantial, what will emerge as the new risks that we haven't currently identified that happen as a result of the fact that now you're talking about tokenized forms of money being used at scale 24/7 in a way that delivered by some participants that are completely new to the marketplace, some participants that are not new at all, central banks, but aren't used to doing that particular kind of activity, and the mechanisms around things like or liquidation and so on at speed and at scale is going to generate interesting operational issues that I think require there to be a pretty consistent tokenization across the whole stack. So I think that if you're using vast amounts of stablecoins, so private issued money, then the reserves that sit behind those need to be as agile as the stablecoin is in terms of its ability to actually liquidate positions and actually provide that cash back to customers in the stress events, which then has a prerequisite that all the way down to the wholesale market, you also have tokenized money. And I think if you have bits that are missing in that, that's going to really identify areas of stress and strain.
Yeah.
Yes, Fernando, I'm going to give you the last word on this.
Onto that, I think there's going to be both public and private, and the public one is going to underpin the private one. Yeah. But I also think the most innovation is going to happen on the private side. In the capitalistic markets like ours, that should be the case by definition, right? So we need your help as enablers, but I think it's going to be private sector innovating and bringing the benefits of programmability, mobility, self-custody to the end user. So I'm optimistic.
You know, ladies and gentlemen, probably many people in this audience have had the opportunity to moderate panels before. I've certainly done my share. I've never had a panel like this where I barely had to ask any questions because they've got so many interesting points of view. So we'll all be available in the bubble outside to answer further questions, and I see we've got a lot stacked up, so please join us. But before we do, please help me in giving a round of applause for a great panel.
Thank you, Chris.